Hey traders! Do you know those red and green sticks on your chart? They're not just random shapes, they're candlesticks, and each one has a unique name and meaning. From Doji to hammer, shooting star to engulfing patterns, every candle tells a story. These candles reveal the hidden battle between buyers and sellers, bulls and bears, fear and greed. When you learn to read them, you're not just looking at price. You're unlocking the psychology of the market. You'll be able to spot trends, reversals, and signals before most traders even notice. In this video, you'll discover how candlesticks work step by step, the most powerful candlestick patterns, and how to use them to trade smarter and with more confidence. Welcome to A-Bean Trade, your go-to place for simple, powerful trading insights. Let's dive in and decode the market together. So first, what is a candlestick? It's basically a picture of the market for a certain time frame. It could be 1 minute, 5 minutes, 1 hour, or even one whole month. Each candle shows how the price moved during that time. Every single candle has 4 key points: the open price, where the market started; the high price, the highest level the price reached; the low price, the lowest level it touched; and the close price, where the market ended. Now think of it like this. Every candlestick is like a small story. If the price closed higher than it opened, it means buyers were stronger in that time. If the price closed lower, sellers were the ones in control. Alright, let's zoom in on the structure. The thick part in the middle is called the body. This shows the opening and closing prices. The thin lines above and below are called wicks, or shadows. These show the highest and lowest points the price touched during that time. If the candle is green, it means the market closed higher than it opened. Buyers were winning. If it's red, the market closed lower than it opened. Sellers were in control. Now, here's where it gets interesting. The size of the body and wicks gives us even more information. Example: if you see a long green body, that means buyers were very strong and pushed the price up a lot. Imagine a stock opening at 100 and closing at 120. That's a big move. On the other hand, if you see a long red body, sellers push the price down hard, like a stock opening at 120 and closing at 100. If the body is short, it means there wasn't much movement. Buyers and sellers were kind of balanced, like a tug of war where neither side won. Now, about the wicks. A long upper wick means the price tried to go higher, but sellers pulled it back down. For example, a stock went up to 125 but closed at 115. Sellers rejected that higher price. A long lower wick means sellers tried to push the price down, but buyers pulled it back up. Like when the price fell to 95 but closed at 105, buyers stepped in. If the wicks are short, it means the price mostly stayed close to the open and close. Not much fight happened. So you see, a candlestick is not just a shape on the chart. It's the story of the market, who was in control, how strong the movement was, and how much rejection happened. And once you learn to read candlesticks, you're not just looking at numbers. You're actually reading the psychology of traders, buyers, and sellers. This is the foundation. In the next parts, we'll go deeper into candlestick patterns and how to use them in trading. Now that you know what a candlestick is, let's go one step further and look at some of the most common and powerful candlesticks you'll see on your trading chart. Doji. This candle has almost no body. It means buyers and sellers are equal, so the market is confused or undecided. Hammer. A small body with a long tail at the bottom. If you see this after a downtrend, it's a sign that buyers are coming back and the price might go up. Hanging man. It looks like a hammer, but it appears after an uptrend. This warns us that sellers may start taking control. Shooting star. A small body with a long tail at the top. It shows that higher prices were rejected, and this often signals a bearish reversal. Spinning top. A small body with shadows on both sides. This shows confusion or low momentum, where neither buyers nor sellers are fully in charge. Now let's look at candlestick patterns made of 2 or more candles. Bullish engulfing. A big green candle completely covers the red candle before it. This shows strong buying pressure and possible upside. Bearish engulfing. A big red candle swallows the green one before it. This means sellers are strong and the price may drop. Morning star. This is a 3-candle pattern. First a red candle, then a small indecision candle, and then a big green candle. It's a strong bullish reversal sign. Evening star. The opposite of a morning star. First a green candle, then a small candle, and then a big red candle. This signals a bearish reversal. 3 white soldiers. 3 big green candles, one after another. It shows powerful bullish momentum. 3 black crows. 3 big red candles in a row. This shows strong bearish momentum and sellers taking over. These candlesticks and patterns are like the alphabet of trading. Once you learn to read them, you'll be able to understand the story of buyers and sellers in every chart. And the more you practice, the clearer the market psychology will become. Now that you know the different types of candlesticks, let's talk about how to actually read them and apply them in your trading. Remember, a candlestick isn't just about price. It's about psychology, about what buyers and sellers are really doing. Step 1. Look at the body. The body tells you who's in control. A long green body means buyers dominated. A long red body means sellers dominated. A small body means neither side had full control. Step 2. Look at the wicks. The wicks tell the story of rejection. A long upper wick means sellers push the price down from the highs. A long lower wick means buyers push the price up from the lows. Step 3. Look at the context. A single candle alone means nothing. Context is everything. Always ask, is this candle forming at the top of an uptrend or the bottom of a downtrend? Is it near a support or resistance level? Does it confirm or reject the market trend? Example 1. The hammer. If you see a hammer after a strong downtrend, that's a clue buyers may step in, signaling a possible reversal. Example 2. The shooting star. A shooting star after an uptrend is a warning sign of weakness. Sellers might be ready to take over. Example 3. Engulfing patterns. Engulfing candles are powerful. A bullish engulfing at support can mean the market is ready to move higher. A bearish engulfing at resistance often signals sellers are back in control. Step 4. Always wait for confirmation. Don't trade based on just one candle. Wait for confirmation, either from the next candle or from other indicators like volume, RSI, or moving averages. Candlesticks are like the market's language. The more you practice reading them on real charts, the more fluent you'll become. And once you can truly hear what the candles are saying, you'll be able to make smarter, more confident trading decisions. And that's the power of candlesticks traders. From a single candle to full chart patterns, each one tells the hidden story of buyers and sellers. The more you practice reading them, the more confident you'll become in spotting reversals, continuations, and opportunities in the market. So now it's your turn. Open up a chart, look at the candles, and start decoding the market's language yourself. If you found this video helpful, don't forget to hit that like button, subscribe for more trading insights, and drop a comment below on which candlestick pattern you use the most. Remember, every great trader started with the basics, and candlesticks are the foundation. Stay focused, keep learning, and trade smart. See you in the next video.